What kind of correction are you anticipating here, Jim?
Well, Daniela, it's been over 10 years since we've had a bear, well, it's been 10 years since we've had a bear market. That's very, very unusual. It could be 20 years. We don't have to have bear markets every so often, but we always have. So the next bear market's going to be the worst in your lifetime, the worst in my lifetime, and I'm older than you, Daniela.
So in terms of numbers, we're speaking an over 50% correction, Jim, if I ask you to quantify it somehow?
Absolutely, the worst in my lifetime. You can look it up. It's pretty simple.
All right, let's turn to gold now, Jim. It reached its highest level since August 2016, last Wednesday, as jitters grew over Syria and Russia, and of course that potential trade war with China. This Monday, however, gold is not really moving, and investors are asking, why not here, Jim?
Well, in my view, and I have a little bit of experience, when there's a lot of bad news and something doesn't, like gold, doesn't go up, it means it's not going to go up. The correction is not over for gold. Likewise, if you have something that's going up and good news comes out and it doesn't go up, then it means it's not going to go much higher. It's time for a correction. So I'm still waiting for a much, much better price to buy gold. And it looks like, at least today and this week, the market agrees with me.
Okay, so you're also still waiting for that bull market to begin then for gold?
Oh, yeah. No, if gold goes to 1,000, I hope I'm smart enough to buy a lot of gold. Because before this is over, Daniela, gold is going to go through the roof. When people lose confidence in governments and money and paper money, they always buy gold and silver. Whether they should or not is irrelevant. They always do, and they always will.
Let's turn to Trump's tax reform now, Jim. Do you think it will deliver the kind of growth the Republicans were promising?
It's going to produce growth for a while. But again, Daniela, there are many problems out there in the world. Interest rates are going to be going higher. Looks like Mr. Trump wants war, at least trade war. All of these things are not good for markets, especially after a 10-year bull run.
We've had financial problems in America, let's use America, every 4 to 7 years since the beginning of the Republic. Well, it's been over 8 since the last one. This is the longest, or the second longest in recorded history, so it's coming. And the next time it comes, you know, in 2008 we had a problem because of debt. Henry, the debt, now, that debt was nothing compared to what's happening now. In 2008, the Chinese had a lot of money saved for a rainy day. It started raining, they started spending the money. Now even the Chinese have debt, and the debt is so much higher. The Federal Reserve, the central bank in America, balance sheet is up over 5 times since 2008. It's going to be the worst in my lifetime too. Be worried.
US national debt hits $21 trillion. For 8 years, we took every opportunity to point out that under Barack Obama's administration, US debt was rising at an alarmingly rapid rate, having nearly doubled, surging by $9.3 trillion during Obama's 8 years. It now appears that the trajectory of the US debt under the Trump administration will be no different. And in fact, based on Trump's ambitious fiscal spending visions, may rise even faster than it did under Obama. We know this because as of close of Friday, the US Treasury reported that the total US debt has risen above $21 trillion for the first time. Putting this in context, total US debt has now risen by over $1 trillion inside Trump's first year, and the real spending hasn't even begun yet. What is amusing is that Trump, who has a tweet for every single occasion, and who no longer even pretends to care about the unsustainability of US spending, was extremely proud as recently as a year ago by how little the debt has increased during his term. We doubt today's milestone will be celebrated on Trump's Twitter account. And while some can argue, especially adherents of the socialist magic money tree, or MMT theory, that there is no reason why the exponential debt increase can't continue indefinitely. One can counter with the following chart from Goldman, which shows that if one assumes blended interest rate of roughly 3.5% as the Fed does, and keeps Americans' debt GDP ratio constant, in a few years the US will be in what Goldman dubbed uncharted territory, and warned that the continued growth of public debt raises eventual sustainability questions if left unchecked. The bad news, however, is that debt GDP will not be constant, as the CBO recently forecast in what was actually an overly optimistic prediction. Is the US economy really growing? No. Most people are aware that GDP growth has been lower than expected in the aftermath of the global financial crisis of 2008, GFC. For example, real GDP growth for the past decade has been closer to 1.5% than the 3% experienced in the 50 years prior to 2008. As a result of the combination of slow economic growth and deficit spending, most people are also aware that the debt-GDP ratio has been rising. However, what most people don't know is that over the past 10 years, the dollar amount of the cumulative government deficit spending exceeded the dollar amount of the GDP growth. Put in another way, in the absence of deficit spending, GDP growth would have been less than zero for the past decade. Could that be true? Let's begin with a shocking chart that confirms the statements above and begins to answer the question. The black line shows the difference between quarterly GDP growth and the quarterly increase in Treasury debt outstanding, TDO. When the black line is above zero, the red dotted line, the dollar amount is GDP is growing faster than the increase in TDO. From 1971 to 2008, the amount of GDP typically grew at a faster rate than the increase in TDO, which is why the black line is generally above the red dotted line. During the 1971 to 2008 period, inflation, budget deficits, and trade deficits varied widely, meaning that the relationship between GDP growth and TDO was stable even in the face of changes in the economic variables. Regardless of those changing economic variables, the US economy tended to grow at a pace faster than TDO for 4 decades. The only interruptions to the pattern occurred during recession of the early 1980s, early 1990s, and early 2000s, when GDP fell while budget deficits did not. The pattern of GDP growth exceeded TDO changed after 2008, which is why the black line is consistently below the red dotted line after 2008. A change in a previously stable relationship is known as a regime change. Focusing first at 2008 to 2012, the increase in TDO far exceeded GDP growth due to an unprecedented amount of deficit spending compared to historical norms. Focusing next on 2013 to 2017, the blue line has been closer to the red dotted line, meaning that the dollar amount of GDP growth was roughly equal to TDO. If the pattern of the past was, in effect, the black line should have been far above the red dotted line for most of the entire period of 2009 to 2017, because it would be expected that a recovering economy would have produced an excess GDP growth over TDO, but that didn't happen. This article will not speculate on why there was a regime change. Instead, this article is focused strictly on identifying that a regime change occurred, and that few people recognize the importance of the regime change, which is probably why it persists. Taking a quick detour into the sample math of GDP accounting, the level of GDP is calculated by adding up all forms of spending. GDP equals C plus I plus G plus X. In the above equation, C is consumer spending, I is investment spending by corporations, G is government spending, and X is net exports, because the US has become such a heavy net importer. X has been a subtraction from GDP since 2000. For context, at the end of 2017, the level of GDP was 19.74 trillion per the Bureau of Economic Analysis, the BEA. Of that 19.74 trillion, the Congressional Budget Office, CBO, calculated that the US government spent $3.98 trillion, all of which counts towards GDP. In 2017, the government borrowed $516 billion, meaning that the government spent more than it received via taxes and other sources. The main insight in understanding how the government calculates GDP is that all government spending counts as a positive for GDP, regardless of whether that spending is financed by tax collections or issuing debt. Because deficit spending is additive in that calculation of GDP, it makes sense to compare the amount of deficit spending to the amount of GDP growth produced each year. The first 4 columns in the table below show the annual GDP, the annual dollar change of GDP, the total amount of Treasury debt outstanding, TDO, and the annual dollar change of TDO. Comparing the second and fourth columns, it is easy to see that the annual increases in TDO regularly exceeded the increases in GDP. The final column to the right shows the increase in TDO as a percentage of the annual change in GDP growth. When the ratio is greater than 100%, the increase in TDO is responsible for more than 100% of annual GDP growth. Reinforcing the message of Chart 1, the annual increase in TDO exceeded annual GDP growth in each of the years from 2008 to 2016. The only year in which annual GDP growth was greater than the increase in TDO was in 2017, possibly due to the debt ceiling caps, which have now been lifted. The cumulative figures are even more disturbing. From 2008 to 2017, GDP grew by $5.051 trillion, from $14.55 trillion to $19.74 trillion. During that same period, the increase in TDO totaled $11.26 trillion. In other words, for each dollar of the deficit spending, the economy grew by less than 50 cents. Or put another way, had the federal government not borrowed and spent the $11.263 trillion, GDP today would be significantly smaller than it is. It is possible to transform Chart 1, which shows annual changes in TDO and GDP from 1970 to 2017, into Chart 3 below, which shows the cumulative difference between the growth of TDO and GDP over the entire period from 1970 to 2017. The graph below clearly shows the abrupt regime change that occurred in the aftermath of the GFC, a period in which growth in GDP growth exceeded increases in TDO has been replaced by a period in which increases in TDO exceeded GDP growth. Unfortunately, extending the analysis forward tells us the problem will only get worse. Over the entire period from 2008 to 2021, the increase in TDO will exceed GDP growth by $7.531 trillion, $15.843 trillion of TDO compared to $8.312 trillion of GDP growth. While most people would accept that deficit spending is required for short periods to offset economic disturbances, even John Maynard Keynes wouldn't expect it to become the norm. Nor would he expect that $1 of deficit spending would produce less than $1 of GDP growth. Investments and policy implications. The purpose of this article is to clarify the changing relationship between the dollar amounts of GDP growth and budget deficits, which are funded by TDO. If needed, the GDP growth has become reliant on budget deficits post-2008. There are many implications for investment policies across all asset classes. For example, might poor organic growth in the private sector explain the unexpectedly low inflation environment and historically low capital investment? If so, what are the implications for stocks and bonds? Conclusions. All government spending boosts GDP calculations, regardless of whether government spending is financed by tax collections or deficits financed by debt insurance. Isolating the interaction between increases in TDO and the dollar amount of GDP growth, the data show a regime change post-2008 compared to the period 1971 to 2007. In the period of 1971 to 2007, the dollar amount of GDP growth exceeded increases in TDO, except in years in which the economy was in recession. In the period of 2008 to 2017, annual increases in TDO regularly exceeded the dollar amount of GDP growth, which remarkably occurred during years that GDP was calculated to be growing. In the period of 2008 to 2017, the cumulative increases in TDO was a multiple of cumulative GDP growth. The dollar amount of GDP growth was completely dependent on deficit spending. The efficiency of each dollar of deficit spending is declining because the dollar amount of TDO is greater than the dollar amount of GDP growth. In the period of 2018 to 2021, the increase in TDO will continue to exceed GDP growth, per forecast made by the BEA and CBO. That is, GDP growth will be dependent on continued deficit spending. Importantly, if the economy slips into recession, it is possible TDO will grow at well over $2 trillion per year, meaning that the gap between TDO and GDP will get much larger.